Hello and welcome to the look ahead for the week, which will be starting on the 4th of November with me, Fiona Singh-Cotter, Senior Market Analyst at City Index. So as always, I'm just going to put myself on mute and ask you to read through the risk warning. Just one. Excellent. Okay, so we will start as we do usually with just having a quick look. Actually, I think rather than what we usually do is start by having a look at the economic calendar. Just going to quickly run through what's happening in the markets as we head into the new week. So I think it's been quite big stories in the equities market. Obviously, we've had quite a few key earnings out this week from big players such as Alphabet, Amazon, Apple, Microsoft, Meta. And it's been a bit of a mixed bunch. I mean, all of them have beat earnings and forecasts, but that's no longer enough. So, I mean, there has been some concerns just regarding the AI trade, I think, and just with regards to the amount of costs that the AI trade is, or AI investment costs, and whether they're bearing enough fruit for the costs that are being put in. And we're seeing I think, a sense that growth is also slowing in these tech giants, well, some of them at least. Amazon and Alphabet have been the clear winners from earnings this week. But we've seen sort of concerns, I was going to say, over the AI trade with Meta, with Microsoft, Apple, even though their iPhone numbers came in, better than expected, still doesn't seem to have been enough to help the stock. So yeah, we can see here that sharp sell-off in the Nasdaq, also the S&P and the Wall Street, the Dow Jones, all have reversed all of October's gains and are actually actually ended the month lower. So that was really quite a sharp reversal. But then we've also got US elections. So this is what we're going to be talking about. That's the big theme for next week. We're also seeing, I think, ahead of those elections, a little bit of de-risking, which is completely normal ahead of such a big event, and particularly given that it is so tightly, it's such a tight race. So, I mean, there seems to be the polls which are showing that there very much is not much between Harris and Donald Trump, but then you've got the poly markets, and the market seems to be following the poly market and the predictions market much more closely than traditional polls, and they're actually pointing to a Trump win of around 63% at the moment, chances of a Trump win. So those odds of a Trump win have just come off slightly over the last day or so, as Kamala Harris has been gaining ground in key swing states, Michigan and Wisconsin. So they're the areas that we're sort of watching at the moment. That seems to have just changed the poly market slightly, but they still point to a Trump win. But as I said, I think we're seeing a de-escalation, and I don't think it's possible to really call it. I mean, we only need to think back to the 2016 polls with Trump, and there it was very clear that the polls were very wrong. So that's when Trump won, even when the polls were saying that there was no way he was going to win. So, I mean, it's going to be a really difficult one to call. I think what we're looking at as far as trades are, let's just have a look at what the dollar's doing. Just bear with me. Dollar's also fallen back this week. It's the first weekly loss in about 5 weeks. ahead of that US election. We've got it's just testing the 200 SMA there. This is the US dollar index. So after rising up to that peak that we saw at just above around the 104.50 level we were expecting, it has just tipped lower, testing now the 200 SMA at the 103.85 level. So yeah, I mean, we're seeing a little bit of strength today. What happens here will be quite interesting. Obviously, we've got those nerves heading into the election. If Trump wins, then that is broadly considered to be a Trump a dollar positive trade, given that his core policies are considered to be inflationary, such as sort of the tariffs and taxes, and you know, the immigration. So all his policies are considered to be inflationary, which could mean that the Federal Reserve, especially when we combine this with the recent strong data that we've had, although just saying this webinar is being done before the US non-farm payrolls, they will be out very shortly. But basically, so we're seeing that strong data, and if we combine that with you know, expectations of inflationary policy, well, that's going to mean that the Federal Reserve are probably going to adopt a more gradual approach to cutting interest rates, and that would obviously be supportive of the US dollar. We've got the Fed meeting next week as well. The Fed are expected to cut 25 basis points next week. I don't think that much can happen in today's non-farm payroll or the US elections, which would change the fact that the Federal Reserve will be cutting by 25 basis points. It's pretty much fully priced in by the market. Inflation, we've seen it is a little bit sticky still at that 2.7% core PCE was this week, which was a little bit stickier than expected. And also personal spending was a bit stronger than expected. So, you know, we're seeing this resilience of the US economy. But I think what that means is that the Fed is likely to cut more gradually next year rather than skip out the November rate cut. So, I mean, with that in mind, I think that does remain US dollar supportive going forwards. Let's just have a look at what the euro US dollar is doing. The other thing to mention is, what about if there's a Kamala Harris win? What could we see there? I think in that scenario, we could actually see a slight unwinding of that US dollar Trump trade, which could provide some support to the euro US dollar. Although I do believe that that support to the euro US dollar could be limited, as we'll see the attention return to, because she's seen as a status continuation, as the continuation trade from the Biden administration. So I think, you know, we could see the strength in the US dollar relatively short-lived, lacking durability, as the attention turns back to economic and monetary policy divergence. Obviously, the Eurozone economy is showing signs of being weaker, considerably weaker than the US economy. So that, combined with the fact that the ECB are expected to continue cutting rates, means that we will see potentially a weaker US dollar, euro US dollar, even if we do see a reaction to the trade, which is more supportive. Just as far as economic data for the euro next week, I think it's actually very quiet. There might be some retail sales data. There we go. There we have it. That are in focus. They rose 0.8% in September. And then so that's it. There isn't much going on as far as Eurozone drivers are concerned. So the main driver of euro US dollar clearly is going to be the US dollar. If we get, so we're just at the moment, we're just trying to push above the 200 SMA, which is actually quite a key level. You know, so if we do get above that 200 SMA, that could give buyers some more momentum to head towards 109, which is the round number, the 109.50, which is the 100 SMA, and then 110. On the downside, failure to sort of move convincingly above the 200 SMA could see the 108 level come back into focus on the downside. Other one we're just going to be having a quick look at is the GBP US. Oh, hang on, sorry. Let's just have a look at the other US stocks whilst we're just covering off US and the elections. As far as the stocks are concerned, I think if we get a Trump win, that could be considered good news as far as stocks are concerned, because of it, the reduction in taxes that are expected, because of the lower regulation that is expected. That could all be beneficial for stocks, even if it does mean that the Federal Reserve will be cutting interest rates at a slightly slower pace. Just as levels to be watching. I mean, we're at that all-time high, weren't we? Just below 5,900, and then it sort of, we saw a consolidation at that period, and we had quite a strong aggressive breakdown of that support level there at 57.75, testing now the 500 SMA. Let me make it a bit bigger for you, you can actually see what I'm talking about. There we go. Testing the 50 SMA there, which is also 5700. So that's a level that's managing to hold right now. If we get a break below there, then just watch out for the 56.75, which was the high that we saw back in July, also the low that we saw at the beginning of October. So there's sort of a support zone around there. If we do get a break below that, that's going to mean that we see a lower low, changing the structure of the chart and opening up a move towards the 55 level. If this holds, if this support holds, then we'll be looking to test on the upside that resistance on the way back, which is, as I said, that was the high that we saw in September, which was around the 57.75 level. So that's US stocks. As far as earnings are concerned next week, not as big a week as obviously this week, but I think it's pretty difficult to get any bigger than this week. So we will be looking at ARM, Holdings, Qualcomm, Airbnb are probably some of the bigger names that will be released next week. But as I was saying, as far as stocks are concerned, if you're thinking sort of, that the Trump, then as I said, that could be beneficial for stocks. Kamala Harris, she is seen as the continuation. So supposing we have, but at the same time, she is looking at certain tax increases, which could be troubling for US, corporate US. So, I mean, we could see a knee-jerk reaction with a sell lower should Kamala Harris take the keys to the White House. However, if we do get a Republican Senate or House, or both, even if we sort of maintain that gridlock, then actually we could just see a continuation of the bullish run that we've seen over the past few years. So next one to move on to is gold. I think just whilst we're talking about uncertainty and the rest, let's just take a quick look at what's going on in gold. We had that all-time high just below 2,800. Obviously, this has been driven higher by the uncertainty surrounding the US elections, by expectations, that global central banks will continue easing. And also ongoing central bank buying of the precious metals. So at a record high, just actually fallen away from that level at the moment. I think the one that I'm looking out for here, I mean, I suppose there could be some interim support there at 1713. That would be the low from last week. Otherwise, watch out for this level here. That's the 26.85. That's the high from the September. That's the one to be watching out for. If we get a break below there that negates just that near-term uptrend, then be watching out for 2600 on the downside. Break below there creates a lower low. Again, changing the structure of the chart. But for the moment, that uptrend is intact. I think it is a little bit overstretched if we go out on the wider charts, on the monthly and on the weekly. So there is a potential for some pullback, at least in the near term. So as far as gold is concerned, I think, you know, and the Trump or Kamala Harris, I think both of them are potentially supportive of further gold. I think under Trump, obviously, there is more demand potentially for safe haven flows if he ramps up sort of geopolitical tensions and trade tariffs. And also, you know, the budget deficit is supposed to get larger, but under both of them. So, I mean, it was more notable with Trump than particularly what it will be with Harris, but it will be going up either way. So that again is supportive of gold prices. So yeah, that's the situation there with gold. Let's just have a look now. We also have next week the Bank of England. So we've seen the pound US dollar has come under pressure. This week, obviously, we had the UK budget, which, judging by the reactions in the market, despite the Chancellor saying she wanted it to be growth, 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 the market is not convinced. We've seen a little bit of volatility. Okay, nothing compared to 2022 when we had the Liz Truss budget, but that's not to say that it's not still important, the moves that we're seeing. We've seen a reaction in the gilt market. We've seen pound has actually fallen. Now, what's really interesting here is the pound has fallen despite the fact that the budget is considered to be inflationary, because we're going to see, you know, rising labor costs, rising costs for businesses. So that's considered inflationary. But at the same time, we've seen the market rein in Bank of England rate cut expectations. Not a huge amount, but for example, the expectations are for the Bank of England to still cut by 25 basis points next week. But for example, the December rate cut is not really expected anymore. And for example, the market's now pricing in 100 basis points worth of cuts before August next year. That's down from 120 basis points previously. So despite the market reining in Bank of England rate cut expectations, which you'd expect send the pound higher, has actually seen the pound fall. So what does that tell us? That tells us that the market is not convinced that this budget is going to bring growth. And it's just questioning the budget. And that's why we're seeing that weakness, despite the fact that we've seen the Bank of England expectations reined in. So yeah, outlook not necessarily that great for the pound unless we see some weakness in the US dollar. If we see strength in the US dollar, then we could see a further weakening of cable. Key levels we're watching now is 108. That's the level. If we see sellers break below that level, then we're going to see greater momentum in the sell-off, and that brings sort of the 126.75 level into focus. On the upside, you know, if we do have a weakening in the US dollar, that might help the pound move higher. If we have more hawkish commentary from the Bank of England, that might help the pound, but then I'm not sure whether it will that much, given that the market isn't convinced by the budget that was unveiled this week. But on the upside, key level to be watching for is that 130 level. That's the line in the sand, where really above that we're sort of a bit more neutral. Above 130, you've got this week's high, which is 130.40, and then the 131 peak. So the other interest rate decision that we have next week, let's just have a look at the calendar, what we're going through here. On the same day as the presidential elections, on the 5th of November, we've got the RBA rate decision. Now, the RBA is not expected to cut interest rates. It's expected to maintain interest rates at 4.35%. in the November meeting, and in fact they're expected to maintain it for the rest of the year. And basically, as economic activity and inflation, sticky inflation, have called for a cautious approach from the RBA. Inflation data we had this week, it was down to 2.8% in the third quarter, which is within the RBA's 2 to 3% target for the first time in 3 years, but core inflation remains elevated. The jobs market is still strong, and there's basically the RBA had a lower peak in interest rates than other central banks, and therefore it's likely to be slower to ease policy than other central banks. Equally, we've seen this sell-off in the Aussie dollar here. This in part has been US dollar strength, in part it's been the market just bringing forward rate cut expectations, even though they are still not expected until next year. We're below the 200 SMA, however, we're finding a little bit of support around the 65.50 level. That's where it seems to be consolidating. RSI is supportive of further losses. You know what, if we can take out the weekly or the monthly, the October low of 65.35, then that's going to bring 65 round number into focus. And if we get a break below that, well, I mean, we could go quite a lot lower, couldn't we? 63.70, something like that, but that still feels quite a long way away. On the upside, any recovery will be looking to push above 66.30 in order to negate the near-term downtrend and neutralize the positioning before we look to sort of move above the 100 SMA at 67. So that's the RBA. What else have we got going on next week? We've got some China data, which will be interesting because obviously we've had China data this week, which has been encouraging, given the recent stimulus announcements. That's something that appears to be making its way into the markets. So with that in mind, let's just have a look at what's going on in the China A50. You can see we're still sort of consolidating after that big move that we had, that big breakout. We're still sort of consolidating around this level here. We've got that 13,500 is the line that really buyers need to push above in order to get more gains. I think what's happening here is the market's just trying to assess after the stimulus whether it's going to be sufficient enough, and I guess that's going to take time for more data to come through. Positive data, the RSI is neutral, this is consolidation, so you know, if we do get some upbeat data, that may help push above that 13,500 level towards 14,400. On the downside, you've got the level there, which is just below the 13,000, which was the low for October, which would be a level to keep in mind on the downside. Below that, we exposed the 200 SMA there at 12,300, or just below 12,300. So they're the levels to watch for that, I think. And then let's just have a look at Hong Kong. A similar pattern, a similar picture. So we've got the RSI neutral, we've got this consolidation, as if we're waiting for signs that those measures, stimulus measures, are actually having a positive impact and will be sufficient. On the upside here, I'd be looking for around 21,000, break around 21,000 could be the start of a move higher. That's the high that we saw at the end of October. On the downside, I mean, there's this immediate support here at 20,400, and then we've got obviously this low here for the October, which was 19,850, which would be a level to break on the downside. And then just finally, let's take a look at oil. Quite a messy little chart, this one, but we've seen some interesting moves in oil. There's been quite a bit of volatility going on here. So, I mean, not only has it found support from the prospect of possible ceasefire talks in the Middle East, but also encouraging manufacturing data from China. We've also had some buying for strategic reserves in the US. We've had a slight weakening of the US dollar this week. We've had a larger than expected draw on inventory. So there's been quite a lot of supportive moves, data and fundamentals. Also, OPEC have reportedly said that they may push back the voluntary, that they've got the voluntary cuts going on at the moment. And they were going to start undoing those voluntary cuts as from December. However, there are reports that they may push back a month or so on that, just because they're concerned over the soft market at the moment, both as far as supply and demand are concerned. So I think we're just approaching that 71.50, 72.50 zone that we've spoken about on so many weeks now. But we do really need to move above that zone in order to see a move towards the 75 level, which is the 100 SMA and the round number ahead of that 200 at 77. On the downside, support is here. It got tested again, the 67.25. That's been a level that we've been watching on the downside for some time now. That was the level that we saw was back in December and back again in June, where it's been quite important. So that's another level to be keeping an eye on. So excellent. That is all from me. Obviously, just keep in mind there's going to be potentially a lot of volatility over the coming days around the US election and the central bank meetings next week. So just make sure you've got an eye on your risk management strategies as well. So brilliant. Well, thank you very much for joining me. Great to be with you again, and I look forward to catching you all next week.